today is 29th of September 2025, 8:30 p.m. Malaysian time. Good evening, everyone, and thank you for calling in. So we are going to go through what the October 2025 global trend forecast will be, and the theme of this month for October 2025 forecast is stagnation. So for those who are new to our platform, can you just can you identify yourself? Is this is your first time to call in? Can you just put a 3 in the chat box if this is the first time you call in? Because I saw quite a number of new names here. Yeah, thanks kindly, Lillian, for calling in. Everyone knows us well? Hi. Yeah, hi, kindly. Okay, so yeah, let me just explain a little bit what we are trying to do here. Both PC and I are applying. I'm applying Chinese astrology, and PC is applying his detailed trend research to focus on the economic, financial, political events to uh, which will impact the global trends and will impact the market condition and also investment related assets, which assets to invest in such a chaotic time. So our aim is actually to help our members to make a better investment decision, okay, through the knowledge of where the global trends is going. So let me just go through what are the talk agenda for today. We will start with the introduction, the disclaimer, and then a brief recap of last month's forecast and the influence of the five elements energy using astrology forecast for October 2025, and followed by PC. He will also do a recap of last month, followed by what is his research on October 2025, the geopolitical and financial global trends forecast. Okay, then we will end with a summary. Before we start, let me go through a disclaimer here. So the content here is purely based on our studies in global trends in relation to five elements Chinese astrology, and also global trends research for you to use as a guideline in your investment decision. And we will advise you to exercise caution in investment, as we know it's a very volatile situation, especially now the index, especially I think the US stock price is really very high now. Okay, so whatever goes up will also come down, but I cannot tell you when the timing is. Okay, so to prevent you from asking me the question again when the timing is. Okay, so we will roughly share the trend with our members. So you have to do your own research on the company you want to invest. We will not give any stock advice in this platform. Okay, for members, if they need additional support, they can go through our email address, okay, and the members telegram group. So we analyze different regional economies such as US, Europe, China, and definitely there will be inherent biases in the regional perspectives. So our observation is based on our study on the current economic trends and does not reflect any absolute or definitive judgments of any specific region. Okay? Yeah. So yeah, just now I already introduced ourselves, and actually we have already started this platform I think since 2022. We are already in the third year. Okay. It's in the third year. I think we are in already in 38 or 39 episode already. Okay, so I think for the past track record, most of our member can attest that what we have accurate, what have we have forecasted is quite accurate. We wouldn't say 100%, but at least about 80%. And I think most of our members, based on based on our study, has also made some, have also invested in some very profitable investment. Okay. Yeah. So we have, written annual forecast books since 2022, okay, for the upcoming years. So now we are preparing for the 2026 Firehorse Astrology and Global Trend Forecast. The book will most probably be launched in October. Okay, and we will also at the same time launch a new registration of the membership for the upcoming years. Okay, so let's recap on the month September 2025, what we have forecasted and what the actual trend is. Okay, so what we have forecasted, there will be great changes, and also the image of Yi Yu, that means the wood. I'm saying that the metal energy from the Yu is actually a metal, okay? And then wood itself on the heavenly stem where the metal will chop, the earth will counter the heaven. So that's why there will be a lot of man-made act of destruction that is going on, intense warfare, and also there are more unrest, conflict around the region like Indonesia. Okay, we can that's nearer to Malaysia, and also global tension and abrupt changes in weather patterns. And we have a lot of typhoons that is ongoing, right? Like Regatta typhoon. I hope it does not attack Philippines. I know that we have some Filipinos in our audience, among our audience here. So there are also earthquake, and then we talk about precious metal is gaining attention, which is quite true, and a time of withdrawal as well. There will be some withdrawal that is going on. Okay, so you look at the news headline, you can see that there's a lot of targeted um, destruction where Russia has also launched an attack using drones, and also in US, I think there is a lot of unrest, like the ICE internal security or immigration shooting, right? In Dallas, and also the Israel riots in Yemen. This among the few, and also the economic warfare of Trump's administration and the EU as well, that they are diverging and approaching to sanctioning Russia. Okay, and also the global tensions where the whole world is dying. You can see that the four major Western nations has started to recognize Palestinian state, which is also challenging Israel, and indirectly it will also challenge the power of US. Okay. And also cyber warfare that's going on. I think European airports, I do not know whether we have any Europeans audience calling in. We have, I think the airports has been snared by cyber attack and disruption on September 21st. And also the UK's Jaguar ran over cyber attack that, hits them, where it caused a shutdown for 4 weeks for them to recover. And definitely, unfortunately, there is also unrest even in Philippines, Nepal, Indonesia. Okay, these are all not quite big that's in the headline, and abrupt changes like the cold temperature that happens in US, and then there is also earthquake and rain floods in Calcutta, and recently I think there's a typhoon in, I think this weekend, right? In around Hong Kong, Philippines is like a super typhoon. Okay, and then the precious metal price is, the movement is upward. Okay, and also some strategic withdrawal in the Middle East part, where that um we are asking, I think era has announced the date to sort of, end the coalition. Yeah, but unfortunately, it's been postponed as well. Okay, so let's go through the month of October 2025 energy, where the chart is lack of water overall, means that the the leader of the year, because this year is a wood snake year, right? So we have the leader of the year here. Okay, wood needs water, right? That means there's no support. That means either the top management or either the global leaders has no support. Okay, the chart in this chart, I think the earth is very strong, and also there are dog and dragon appearing in the earthly branch. I think in the day pillar, so we can see that there is a clash. So this is also a problem here. When earth is strong, things tends to be conservative. Okay, and also there are, security that needs to, earth also represents security, so the domestic security of each nation will be strengthened as well. And there are a clash of earthly branch. As I say, there are appearance of dragon and dog together. So it will heighten the risk of earthquakes, landslides, and the instability of the soil. Okay. And because of the earth and metal, which is a slow element, so we can foresee a sluggish market and some supply chain blockage. So most probably the agriculture wood will be sort of weak because of the unpredictable weather condition, and the market might be a bit bearish. Okay, and possibly there will be a dry cooler weather in the northern hemisphere, and with sudden warm spells as well. Okay, so for this month October, I think it is the end of the autumn month already, because when dogs comes in, dog is a graveyard animal, which signifies the end of a certain season, where they store a lot of, energy, different energies of previous and upcoming previous seasons. Okay, yeah, let's look at the hexagram of the month October 2025. Is actually hexagram number 52, which is stagnation. Why is stagnant? Because it's actually, you can see, it's mountain over mountain. Okay, if you look at the trigrams that makes up the hexagram, there are two trigram, the heaven and the earth. So it's all mountain. This is Kengua, by the way. Yeah. So when you see mountain, they store a lot of things, but at the same time they are slow. Things are stuck. Okay. So the decision making from the leader also might be slow, and a lot of people will also adopt a defensive strategies as per the four pillar master chart, which we have go through for the month of October. Okay, so advise that you use this stagnation to consolidate your resources, strengthen your foundation, and prepare for the future movement. Okay, so I do not know whether PC has a similar forecast as me based on the October trend. We shall look at it. So over now to you, PC, to go through your part. I will stop sharing so that you can share. Yeah, PC, are you there?
Yep.
Okay, good.
Hold on.
Okay.
Okay. So, mm, Let me on my video. So can see my screen? Okay. So let's go through September. Um, Now, we start off with the US. We said that there could be wider discrepancy between CPI and PPI as the former would stall while the latter would gain. But the opposite happened. CPI gained while PPI fell. So part of it was because we expected that the tariffs would actually increase input prices, but that did not happen. Rather, the PPI fell due to import prices coming in lower than expected. So CPI gained 2.9% year on year, up from 2.7%, driven by many retailers needing to increase price to offset higher costs of imports. And PPI gained 2.6% year on year, down from 3.1%, led by moderating costs in housing and medical services. And this is particularly true because the cost of lumber fell 20.9% in August. So we expected US dollar to weaken over time after Fed cut interest rates like it did in December 2024. So far, it has risen from 96.725 to 97.805 in the DXY and gaining 1.12%. And similar to the trend in December, immediately after the rate cut. Thereafter, the DXY fell after reaching a peak. So the jury is still out whether DXY will trend lower. So this was the last interest rate cut. And what happened was the DXY strengthened up to a point on the 13th of January where it reached 109.91 for a gain of 1.81%. But from here to the bottom here on 16 September, it fell 12.1%. So what we are witnessing here is that immediately after the interest rate cut, the DXY spiked slightly. And if let's say it should fall because of subsequent rate cuts coming in November or December, then there's still another 50 basis point cut coming in for this year. Then we would likely see the DXY falling further down. Now, during the peak of the global financial crisis, as the Fed cut interest rate aggressively, the DXY actually fell to a low of around 69. Right now, we are at 97.78, which means if the Fed continue to cut aggressively this year and next year, probably we will see the DXY falling below 90. And that would actually signal that there is still leaks in the precious metals rally. So in China, after Chinese government revealed policies to boost the real estate market, we mentioned that major developers would gain, but we were half right. After rising substantially from 1st of September to 16th September, many started falling due to profit taking, and now many have remained in the red month to date as of 25th September. So we were half right, okay, because a lot of developers actually went up, but I think there was a lack of follow through, and because people are still skeptical about the developers in China. So I guess after that reason, I think some stocks actually went double digit. And I guess many investors decided to bail out with their profit. So, but where we got right, as predicted, after the Fed cut interest rates, both the stock and commodities market saw gains. The S&P gained 38 points from 6,600 or 0.58%, while the GSCI index, also known as the Goldman Sachs Commodity Index, gained 4 points from 553 to 554 or 0.72%. So the gain is rather muted. But I think over the weekend, there was last week there was some rally. Okay, so the S&P might have gotten a bit higher from there. So the primary movers were actually gold, which gained $82 per ounce from 3,664 to 3,746. But right now, it's actually much higher. Okay, right today, gold is already at 3,850. But during the time of preparation last week, the gold actually went up by 2.24%, and silver gained $2.41 per ounce, with a 5.8% gain. Of course, the gain right now has gone up further because the silver on Friday reached a high of $46.66. So as expected, US yield saw after the rate cut, the 10-year UST rose from 4.084% on 17 September to 4.153%, gaining 6.9 BPS. The US Treasury Department continued to repurchase US debt. In September alone, the department purchased a total of $6.75 billion of US debt. So we mentioned that the US could see another huge budget deficit in August as debt continues to rack up. Total US public debt as of September was 37.524 trillion, with August budget deficit reaching 345 billion. Just put a B here. For a year-to-date fiscal deficit of 1.973 trillion. Now, we all know that the US government's fiscal year will end this month. And with August already at 1.973 trillion deficit, very likely for the whole fiscal year, the deficit will actually exceed more than 2 trillion. So based on the Fed's post-FOMC statement, the focus will shift to jobs creation instead of combating inflation. There will be another 50 BPS cut till the end of the year, and this signals that the Fed is becoming increasingly dovish. Now, the Fed actually has two mandates. One is to ensure price stability, and the other being sustaining jobs growth. But right now, torn between the two, looks like the Fed is opting for sustaining jobs growth. So Trump has increased the US naval presence off the Venezuela coast. He has demanded that the Afghanistan government returns the Bagram air base back to the US and warned of serious consequences if it does not oblige. So we can see that the US is becoming more belligerent. And this is mainly because there is a lot of external pressure as well as internal pressure. Now, in Europe, we mentioned that the weak economy in the UK, Germany, and France could affect the broader European economies. So here you can see that throughout the 2025, the broader Euro area industrial production has remained below 5%, which was last achieved in September 2022 outside of the pandemic recoveries. You can see that this was the only spike in industrial production in Europe, mainly driven by the pent-up demand after a period of lockdown. But ever since reaching 5% here, you can see that the Euro area industrial production has actually been in a very narrow band that hovers between negative to positive, but never above 5%. So this is despite the ECB cutting interest rate 4 times in 2025. So we mentioned that inflation in the broader European economies will remain elevated. So you can see that the 2% inflation rate, which is actually the ECB target, has risen above the 2% inflation rate in some of the months. And for most of 2025, Euro area inflation remains elevated at 2% or higher, except in the month of May when it was at 1.9%. Then we mentioned that employment conditions will worsen in Europe. So jobs growth has been below 0.5% since Q1 2022. Jobs growth in Q1 2025 and Q2 2025 was just 0.2% and 0.1% respectively. So if we were to draw a cascading line from here to here, you can see that there is actually a slowdown in jobs growth. So Euro area is stuck in stagflation with elevated inflation and worsening employment conditions. Growth has not exceeded 2% since Q2 2021 at 2.2%. GDP in Q2 2025 has fallen to 0.1% from 0.6% in Q1 2025, a sign that growth would continue to slow in the near future. So we also highlighted that there will be political turmoil in UK, Germany, and France, and these are some headlines. And both the Great British Pound or Great Britain Pound and Euro weakened against the US dollar in September. The GBP weakened 1.16% against the USD as of 25th September, while the Euro weakened 0.28% against the USD as of 25th September. So in China, retail sales came in weaker at 3.4% year-on-year in August versus 3.7% in July. We mentioned that China's going to see some weak consumption, and it is turning out correct. Inflation fell 0.4% year-on-year in August versus unchanged in July due to weak consumption. We mentioned that the Chinese government AI plan would boost the tech stocks, and we were right. As of 25th September, the Hang Seng Tech Index has gained 580 points or 10% month to date. So hopefully when some of you all have hopped on the sudden surge in Chinese tech stocks, those in the Telegram channel, I've posted some of the stocks that were in focus by investors. Yeah, Evelyn?
No, I say yes. There are actually most of the stocks that we posted in the Telegram group we study has gone up quite significantly.
Yeah. So in AI, China continues to launch new models. And a new hydride ion battery was revealed. So we mentioned that China will come up with new technology breakthroughs. So, but what is going to change the landscape of electric vehicles will be CATL's hydride ion battery, which actually is very different in a sense that it will actually eliminate sudden combustion of the battery in the event of accident, because I think if I read it correctly, they have totally removed lithium ion from the battery. But CATL claims that it can provide 6 times the capacity of lithium ion. So it's a very interesting development. And because it is very cheap, that it will make EVs even cheaper. Okay. And therefore, Chinese EV manufacturers will continue to take a huge slice of the global EV market. So let's look at the US economic indicators. US GDP revised up to 3.8% year on year from 3.3%. But behind that, there's a number of issues which I will highlight afterwards. So CPI rose 0.4% month on month in August. Year on year, it grew 2.9%, up 2.7% in July. Core CPI rose 0.3% month on month in August. Year on year, it rose 3.1%, unchanged from 3.1% in July. Here we can see that CPI has gone up versus in August versus 2.7% in July, indicating that the retailers like Walmart, Target, and a number of others have started raising prices, and this is going to hurt the US consumers. So the CPI would actually gradually show small incremental increases. So the PPI fell 0.1% month on month in August. Year on year, it gained 2.6%, down from 4.1% in July, which is revised. Retail sales rose 0.6% month on month in August. Year on year, it gained 5%, up from 3.9% in July. Net retail sales less CPI was 2.1%. So retail sales show a gain, okay, that is quite huge, okay, at 5%, even much higher than China's. But I think underlying that, there are some issues which will tie in with the GDP. So industrial production rose 0.1% month on month in August. Year on year, it rose 0.9%, down from 1.3% in July, which was revised. Durable goods orders rose 2.9% month on month in August. Year on year, it rose 5.4%. So it's not that the US economy is doing badly. Okay, I believe that there is industrial production that is continuing, especially if we look at it in the stock market, there has been substantial gains, and therefore people still would have the cash flow to spend as well as to make purchases. So according to tradingeconomics.com, a part of the increase could be due to higher prices rather than increased volumes, as tariffs on imported goods raise the cost of manufacturing. So this is an analyst input, okay, that part of the durable goods orders rose because of increase in prices related to imports. So NIHB index came in at 32 in September, unchanged from 32 in August. So housing starts tumbled 8.5% month on month in August, while housing permits fell 3.7% month on month. This is the 5th consecutive decline for the more forward-looking housing permits. So this is not surprising because, as I mentioned, the price of lumber has fallen, and the National Association of Home Builders Index is still in contraction. So in the housing market, where construction of homes are concerned, it is showing a contraction. But on the other hand, new home sales saw 20.5% month on month in August as mortgage rates fell. Year on year, it rose 15.4%. Now, one of the reasons could be due to home builders are still holding on to certain inventories, they are unlikely to build extra unless they can dispose of their inventories. And there has been a lot of promotion, and coupled with the reduction in mortgage rates, we saw new home sales bouncing up strongly in August. Existing home sales month-on-month in August, year-on-year, it rose 0.8%. Now, on the other hand, existing home sales is actually those home resellers. We all know that household debt in the US has increased to another new record high. And there has been a lot of distress among credit card holders. On top of that, student loans have seen has seen an increase in terms of delinquencies. Credit card delinquencies have also risen. So I think based on that reasoning, it is not surprising then that some homeowners have decided to sell their homes because home prices are still at an elevated level. They cash out from their home equity so that they can pay off their debt, or also to reduce their debt burden overall. Now, the Conference Board of Leading Economic Index declined 0.5% in August after a small 0.1% increase in July, which was revised up from a 0.1% decline. The LEI fell by 2.8% over 6 months between February and August 2025, a faster rate of decline than its 0.9% contraction over the previous 6 months period. So this is something that is quite worrying, because if we look at the last two recession prior to the recession trends, you can see that there was an uptake before it subsequently fell off. Similarly here, some uptake before it fell off. Right now we are seeing the uptake and is trending down. So I think this is something that you should look at if you want to monitor how the economy is trending. So let's talk about the GDP. Now, the increase in GDP primarily reflected a decrease in imports and an increase in consumer spending, which is inflation-driven. Now, these movements were partly offset by decreases in investment and export. So all the Trump admin needs to do is control the narrative for inflation, which guesswork now accounts for almost 40% of the estimate versus almost zero in January 2025. So here you can see that because US calculates its GDP based on real GDP, which is actually after deducting the inflationary impact. So if we look at it here, actual collection of data from more than 90%, it has dropped down to almost 60%, whereas altered collection that is based on guesswork has increased substantially. So what happened somewhere around here? This was during the implementation of the tariffs. So as soon as the tariffs start to bite, you can see that the measurement of inflation has actually shifted. Now, guesswork is very easy, because if let's say inflation is 10%, I can say that it is just 3%, okay? Because it is not from hard data. But if we want to dissect it further, okay, US Q2 GDP grew 3.8%, but that itself actually grew 4%, outpacing the 3.8% growth after manipulating the inflation lower. So the other thing is, let's look at the reality of what is happening with the movement of goods. Now, this will cement the argument that the GDP is driven by inflation, okay, because retail sales rebounded strongly. But here it is showing that domestic freight is down 12% year on year. And so domestic freight here is actually in the blue, okay? This was the domestic freight. Green was in 2024 and red in 2023. So 2025 domestic freight is actually much lower than the last 2 years. Now this, because freight actually signifies the movement of goods. Okay, if let's say consumption has increased, therefore the movement of goods must increase accordingly. But if let's say consumption has increased, but the movement of goods have decreased, then it could only mean that price was the deciding factor, because the volume actually has dropped. So that means that the narrative that the GDP has grown is not so much as driven by improvement in productivity or the improvement in the volume of goods consumed, but rather on price itself. So that is why what's driving the increase in consumption is the increase in prices. And the other thing is that if let's say the economy is doing so well, why is there a rise in US bankruptcies? So here in 2025, you can see 2025 to date is much higher than 2024 to date, or even 2023 to date. That means more bankruptcies have been recorded to date. And here you can see that in July itself, it was much higher than the last few months. So I think overall, although the economy does look very pristine, okay, at 3.8%, underneath there is a lot of gray data that you need to be concerned about. So in other words, although the GDP shows a very pristine picture, there is a lot of structural damage where the economy is concerned. So let's look at the FOMC meeting. The Fed cut rates 25 BPS in first rate cut in 2025. Current Fed funds rate is at 4% to 4.25%. Median projections show 50 BPS in additional rate cuts for 2025. Now, this will put the Fed funds rate at 3.5% to 3.75% by the end of the year. And Governor Miran, who is a pro-Trump supporter, dissented in favor of 50 BPS cut for this session. Fed said that the downside risks to employment have risen. 6 Fed officials saw no more rate cuts in 2025. 9 Fed officials saw 2 additional rate cuts in 2025. So you can see that there is not a very strong consensus among the Fed governors, okay? But still, the majority opted for 2 additional rate cuts in 2025. So how do I understand all this? I believe that the Fed is choosing employment over inflation. We will see a turbocharged stagflationary event similar to the 1970s. Because right now, inflation is being masked, okay, by a lot of guesswork. But the moment they want to cut interest rate, it will weaken the US dollar further. And that would actually drive inflation much higher, similarly like 1970s. So earlier, before we have the session recorded, there was a question on the sustainability of precious metals. Now, if we base it on the model from 2000 to 2011, gold went up 8 times. And if we follow the same pattern, gold reached a bottom in 2015, which means 11 years later, 2026, it would have risen 8 times. That would mean, okay, gold over the course of the next 15 months will see higher incremental in the daily rally. But if, let's say, we move back to the period of 1971 to 1980, a period of almost about 9 to 10 years, gold actually went up 25 times. So that means that gold rally can prolong even much longer, assuming inflation starts to build up in the coming year, okay, because the Fed is going to have 50 basis point cut in this year, and I think next year there'll be another 50 basis point cut that will put interest rate at around 3%. So if, let's say, inflation over exceed 3%, then everyone will be rushing to hedge against that inflation. But on the other hand, high inflation will weaken employment, because if inflation is high, that means the cost of inputs will be much higher, and companies will have to raise prices. Now, raising prices, of course, would actually impact consumption. So consumption may actually slow down. And that is why the 1970s is known as a stagflation, because low economy output, high unemployment, as well as high inflation. And if we revert to that, then cutting interest rate won't help, because the bond market is not going to buy it. Okay, and we know, because as soon as the Fed cut interest rate, the 10-year yield rose after the Fed cut interest rate. So the US 10-year yield rose 4.084% to 4.153%, gaining 6.9 BPS. And and Wall Street Journal actually come up with an article on why they say that the Fed lowering rates won't instantly lower the borrowing costs. So in a nutshell, if the Fed continue to cut into an inflationary environment, it will going to put inflation into hyperdrive, which will actually slow down the overall economic growth. And that is when, we may exceed Michael Oliver's prediction of gold rising 8 times in a similar pattern from 2000 to 2011, but instead will move a notch higher to the 1971 to 1980 trend line. So right now, the new estimate for Q3 GDP is at 3.9% because of the higher retail sales. All the economic data is pointing towards a lot of positivity. But as I mentioned, all this is done by masking inflation. So if, let's say, the economy is really so strong, okay, and it's on fire, why is there a need for further rate cuts? And if the economy is on fire, why is jobs growth slowing? So this actually is a challenge to the narrative that the US economy is growing very strongly. And you can see that all this, there's a lot of virtual signaling, okay, that I want this to happen. Okay, if everything is so good, why do you want that to happen? And this will put the Fed in a very precarious predicament, because if they don't cut to support the economy, then they will be under fire. And if they don't cut to support jobs growth, they will also be under fire. But if inflation gets out of hand, they will also get uh, get fired uh, for their failure to control to actually manage price stability. So what could happen to the US in October? So the CPI will remain elevated after a number of retail outlets started to increase prices effectively from September 2025. Furthermore, the Fed cutting interest rate will fuel inflation higher. On top of that, Trump just announced a series of tariffs on import, including 25% on all heavy or big trucks, 30% tariff on upholstered furniture, 50% tariff on all kitchen cabinets, bathroom vanities, and associated products. Now, this is going to hit the home improvement industry. So, you know, those that are, I think better stay away from those that are into home furnishing, okay, like Home Depot and, companies like this. So 100% tariff on any branded patented pharmaceutical product, unless a company is building their pharmaceutical manufacturing plant in the US. And I think this is actually counterintuitive, because even if a company decides to build its plant in the US, it will take at least 2 to 3 years for its completion, certification, and eventually approval to manufacture pharmaceutical products. But by slapping a 100% tariff right now, it is actually putting a lot of pressure on healthcare. So the new wave of tariffs by Trump will put more inflationary pressure on the economy. Meanwhile, Trump is reported to be considering new tariffs on semiconductors unless the ratio of manufacturing in the US to foreign is 1.1. Now, this is setting his sight on TSMC. Okay, I think Trump wants to pressure TSMC to shift more production into the US. Underneath the pristine GDP number, there is structural weakness in the overall economy, as evident by the falling domestic freight, falling jobs growth, and increase in the number of bankruptcies. The US debt and budget deficit will widen as the Trump admin tries to grease the stalling economic wheels, which will push the US Treasury yields higher and the US dollar weaker. All these dynamics will spur the gold and silver rally further. There will be more progress on establishing cryptocurrency reserve and the implementation of stable coins in the US. Now, this implementation of stable coins in the US is like a reverse Uno card. Okay, since US Treasury yield is going up, the US will allow corporations to issue stable coins of their own, provided that they are backed by US dollar or US Treasury. So companies will actually issue stable coins, then use the proceeds, okay, to buy US Treasury and therefore bring down the US Treasury yield. But if we see that the Fed launching QE is printing money out of thin air, issuing stable coins by corporations themselves will be like manifold of QE, because imagine if Amazon, Facebook, or Google, let's say, they decide to issue stablecoin and say that, oh, right now, okay, you no need to, we will no longer transact in US dollar, we will transact in stable coins. Now, if let's say Amazon business or Google business, which is in the trillions of dollars, and suddenly they issue their stable coins. Isn't that like printing additional trillions of dollars into the market? Okay, so this is something that, is a gamble. Okay, so this is, and we need to be very careful in digesting how this would progress. And meanwhile, US military will further expand its horizon, and several conflict zones could materialize as Trump admin tries to stay relevant in a chessboard of shifting geopolitical pieces. Domestically, we could see more violence and protests amid rising censorship in the US. I think it is very evident right now on the TikTok deal. For those who think that US have bought TikTok, no, it's not. ByteDance just granted US the license to operate the US brand of TikTok in the US, which um, the majority of the shareholders then can control the narrative in the US. We could also see more National Guard being moved into major cities to quell protests, demonstrations, and crime. So Europe economic indicators, Euro area CPI came in at 2% year on year in August, unchanged from July. UK CPI came in at 3.8% year on year in August, unchanged from July. Euro retail sales rose 2.2% year on year in July, down from 3.5% in June. UK retail sales came in at 0.7% year on year in August, down from 0.8% in July. Both were revised. So German manufacturing PMI came in at 48.5 in September versus 49.8 in August, while services PMI came in at 52.5 versus 49.3 a month ago. France manufacturing PMI was at 48.1 versus 50.4 in August, while services came in at 48.9 versus 49.8 a month ago. UK manufacturing PMI came in at 46.2 in September versus 47 in August. Services PMI came in at 51.9 versus 54.2 a month ago. So among the three major economies in Europe, you can see that France is the one that is actually facing a lot more challenges. So what could happen in October? Germany, France, and UK manufacturing is stuck in a rut. Will remain in contraction due to deindustrialization. Some major companies with long tradition could be under threat due to falling business amid rapid deindustrialization. And in the past 2 weeks, I have read that several companies that has been in existence for more than 100 years have actually closed down. So internally, all three will continue to face political turmoil. Employment growth in Europe is slowing down, and the euro and Great Britain pound will continue to weaken against the US dollar. China economic indicators, CPI fell 0.4% year on year in August, down from 0.4% in July. So core CPI rose 0.9% year on year in August, up from 0.8% in July. PPI came in at negative 2.9% year on year in August, up from negative 3.6% in July. Retail sales climbed 3.4% year on year in August, down from 3.7% in July. And retail sales in the first 8 months grew 4.7% versus 4.8% in the first 7 months. So you can see that generally there is a consumption slowdown in China. Industrial output rose 5.7% year on year in July, down from 6.8% in August. This is July. or there is a repeat? So, okay, industrial output rose 5.2% year-on-year in August, down from 5.7% in July. Fixed asset investment rose 0.5% year-on-year in the first 8 months, and investment in infrastructure went up 2.2% year-on-year, while manufacturing investment increased 5.1%. So you can see that even industrial production is showing a slowdown. And interestingly, fixed asset investment actually fell below 1% in the first 8 months, whereas previously it was more than that. And the other thing is that it did not report how deeply the investment of property has fallen. So normally when China does not put in that figure, it means that it could be much worse than previous. So they just leave it at that, okay? So survey urban unemployment rate on average stood at 5.3% in August, up from 5.2% in July. So overall, we can see that China's August economic indicators fared badly compared with July, with the latter being down from June. So it's like 2 consecutive months of declining economic indicators. So the government may have to expand its fiscal stimulus or risk seeing its GDP growth fell below the 5% target, which it has set itself to achieve. So China's trade data, China total goods imports and export in renminbi denominated terms increased 3.5% year-on-year in August, marking the 3rd consecutive month that both export and imports achieved simultaneous growth. From January to August period, China goods trade also expanded 3.5% year-on-year. Export led the overall expansion during the January to August period, surging 6.9% year-on-year, while imports registered a slight decrease of 1.2%. In US dollar terms, the country export and imports of goods amounted to 321 billion US dollar and 219 billion respectively, accounting for a net surplus of 102 billion in August. For the first 8 months, the figures were 2.45 trillion versus 1.666 trillion, accounting for a net surplus of 0.78 trillion year to date. Now, based on the current figure, very likely China would once again achieve more than 1 trillion in goods trade surpluses. And China real estate. Residential housing prices in China's 70 large and medium-sized cities continue to see narrow year-on-year declines in August. But if we were to pull the chart further back since 2021, obviously the real estate market has fallen somewhere in the region of 30 to 40%. Prices of new homes in the country's 4 top-tier cities, Beijing, Shanghai, Guangzhou, and Shenzhen, decreased 0.9% on average year-on-year, which is a smaller decline than the 1.1% recorded in July. And buckling the trend, Shanghai recorded a 5.9% rise. Other major cities also reported slower declines, with new home prices in second-tier cities down 2.4%, easing from a 2.8% fall in July, and third-tier cities saw a 3.7% decrease compared to a 4.2% slide in the previous month. So generally, it's coming down, but then it's not rising up either. Okay, on a month-on-month basis, the downward momentum in new home prices also eased in the first and second tier cities, although third tier markets experienced a slightly wider decline. So looking at it, China's real estate will still continue to be in the doldrums, even though the government right now is trying to infuse some speculative features into the real estate market. So in terms of electricity consumption, China electricity consumption continued steady growth in August. Country's total power use increased 5% year-on-year to nearly 1.2 trillion kilowatt hour. Primary industry saw a 9.7% increase, to 16.4 billion kilowatt hour. Secondary industry consumed 598.1 billion kilowatt hour, up 5% year on year. Tertiary industry registered 7.2% rise in power use to 204.8 billion kilowatt hour, and power consumption by country residents rose 2.4% to 196.3 billion kilowatt hour. First 8 months of the year, China total electricity consumption climbed 4.6% to nearly 6.88 trillion kilowatt hour. So if we were to base that electricity consumption is closely related to the GDP, here it goes to show that it is still hovering closer to 5. But with the poorer economic indicators, we could see Q3 actually falling to less than 5% in the coming GDP report. So what is China going to do in tackling the slowdown? So with the slowdown in consumption in July and August, maintaining Q3 GDP at 5% would become a challenge. So herein, China has unveiled several measures: accelerate growth in the power equipment industry, upgrading the steel and building materials industry, promote digital consumption, and open up the digital trade sector. Now, there has been also some talk that China will actually look at re-urbanization, because some of the certain quarters of the cities have been developed from 1980s to 1990s. So they may look at re-urbanization to develop more high quality homes. In fact, right now, there is a minimum requirement for developing homes for the citizens, which include a very wide balcony so that they can have a miniature garden, high ceiling, and such. So the other thing is promoting digital consumption and open up the digital trade sector and promote the services sector. And the measures include expanding quality supply through pilot cities for new business models and scenarios, enriching cultural tourism and sport offerings, and improving services in sectors such as entertainment, sports, elderly care, and childcare. So all this will not happen in the month of September. Probably we will see a lot of all this being rolled out in the month of October, November, and December. So what could happen in October? Q3 GDP will likely fall below 5%, as September economic indicators are expected to be weak. And this is similar to Q3 2004. October is the start of Q4, with the first week being the Golden Week holidays, which will spur consumption. This will be followed by November with the Double 11 sales in November to boost consumption. Now, there has been a lot of speculation that retail sales is down in August and September because everyone is saving up for the Double 11 promotion in November. So what happened in the Q4 in 2024 was that there was a huge spike in the GDP, and that helped to narrow everything, that helped to level everything down back to, if I could recall, I think it was 5% or 5.2% overall for the whole year. So something similar might happen again. Inflation in September could remain subdued, but will likely rise in October due to the increased consumption during the Golden Week holidays. Now, for those gold and silver watchers, just take note, China will be closed for 1 week. So there is a chance that the COMEX will actually slam the price of gold and silver down during this period of absence of Chinese buyers. And this has been almost the case all through the years that I've monitored the gold and silver market. But this time, any smash down that will be more than likely will be bought up, because it's not just China that is buying, but a lot of countries as well. Okay, especially those in Central Asia, Eastern Europe, and Asia itself. So real estate will remain weak and property companies will remain subdued. We will see more inflow of funds in the tech sector as companies unveil their AI initiatives. So recently, Alibaba hogged the limelight when they say that their AI chip is comparable to NVIDIA's export version of the chip to China. And even Baidu has come up with some of its own chip, and that is the reason why you see both these stocks have actually risen quite substantially in September. So China will likely reveal more efforts to internationalize the RMB, and this is done through a gold back trade with its trading partners, because the RMB is convertible to gold, and right now the Shanghai Gold Exchange International is establishing foreign vaults in other countries, so that when country uses the RMB swap, if they have excess RMB, they can either pay Chinese companies in RMB to uh, to do infrastructure works in the country, or they can use the excess RMB to convert it to gold and keep it as a reserve. So China is in the process of internationalizing the RMB in this manner, and silver demand in China will rise as an alternative to gold. And physical silver price reached $52.31 per ounce on 26 September, but today it rose to $56.79. And there are right now a number of influencers in China that are recommending investors to buy silver as an alternative to gold. And in terms of geopolitics, the US is ramping up the training and supplies to Puerto Rico, and looks like war is imminent based on certain analysts' observation. So tension in the Middle East remains in conflicts. Remains with conflicts being active in southern Lebanon, Gaza, West Bank, Syria, and the Red Sea. Israel attacked Doha, leading to condemnation against Israel by the Gulf states. Beneath the surface, many forces are at play that could reconfigure the landscape in the Middle East. Now, even though some of the Gulf states got together and condemned Israel, there were actually no retaliation. And some observation by geopolitical analysts are summarizing that beneath the condemnation, there are a lot of shifting alliances that could reconfigure the landscape in the Middle East. So that area remains very volatile and a powder keg. So Trump demanded that Afghanistan returns the Bagram Air Base back to the US, warning of serious consequences for failure to oblige. NATO and Russia inch ever closer to a confrontation, and resumption of tension in the Thailand and Cambodia border, and less tension in the South China Sea as Philippines could witness a political upheaval, because there is right now the attention is no longer in the South China Sea, but in the domestic political turmoil that has suddenly erupted in the country. So, Evelyn, back to you.
Oh, okay. Yeah, let me just share my screen again. for a while, huh? Okay. Yeah. Okay. Yeah. Let me just go through this page here. Okay. Can y'all see my screen now? Everyone?
Yep.
Yeah. Okay. Good. Okay. So, before we go through this one, let's go through some of the. So, yeah, I have a promotion here on the personalized birth chart analysis for 2026. We know that I think many of y'all, if y'all are, following Chinese astrology, we know that 2026 is a pink year, which is a fire energy year. It's also known as crimson horse year. Okay, so it's a force that can empower or it can be overwhelming. So um, if you are interested, you can get a comprehensive annual 2026 detailed month by month analysis report for each month from January to December on for 2026 which you will have in this report there will be like opportunities on career and work, wealth and financial decision, relationships, emotional dynamics, and also health and inner balance for the annual 2026 forecast. And for early bird, it will be 187 only. This is the report only. And if you are interested for a guidance of 30 minutes of Zoom consultation after the report, because the report itself is very comprehensive. When you read, you will understand already. So it will be, you have to add in 167, okay, if you are interested. So the full report will be between 25 to 29 pages. It's a very big report on month to month what you are supposed to do in your different aspect of your life. Okay, so if you want, you can also get this report for free. For those that have not done any, analysis before, now the special offer is at 687 because actually the cost of the analysis for life energy analysis is already 687, and plus this annual analysis is 197, and I will give you a Zoom session if you enroll for the life energy consults together. So actually the total cost is 1283, but now it's 687. And I will give you a free annual report. Okay, if you are interested, later on I will you can scan this QR code or either I will drop you the link later. If you are okay. So we'll start early so that you know what is expected for next year. Okay. So our membership will be open for registration by next month, October, for 2026. For those who are interested, if you have followed us long enough in this platform, I think it's best that you take it to the next level by joining our membership where you have dedicated, Telegram channel. Okay, so once our book is published, we will sell together with the membership where you can get our book for free, or you can either buy the book from an appointed link or the online place or the online bookshop. Okay, so let's go through the summary for the month of October, what to expect. So definitely it will be like more of defensive posture, of increased militarization and slow diplomacy because of the earth that is a lot in the chart, and there are some clashes of the earth itself that will cause high risk of earthquakes and landslide as well, and sluggish growth in different sectors. as I think PC also has predicted using the global trends research, especially in the property market, and there will be a flat and bearish sentiment as well. So it's best that you look into the safe haven aspect. So PC, over to you to do the summary.
Yep, Evelyn. So as I mentioned, although US Q2 GDP saw a 3.8% growth, there are structural weakness in the economy, and US will likely see another month of huge budget deficit as it ramps up its plans for regime change in Venezuela. Now, maintaining a naval force outside, off the coast of Venezuela is not a cheap affair. Furthermore, it is also ramping up deployment as well as training in Puerto Rico. And on top of that, the Trump admin is also organizing National Guard to patrol certain crime-infested cities in the US, which also incur tremendous costs. So overall, I think the September budget deficit is going to be rather huge. So more political turmoil in the West, mainly the US and Europe, and more military conflicts on the horizon. Now, China economy slows in Q3, but will rebound strongly in Q4. HSI, or the Hang Seng Index, will continue to outperform the S&P. So gold and silver will see demand driven by unsustainable US debt and physical demand by banks and sovereign funds. China retail buyers could shift their attention to silver. So maybe we can proceed with the Q&A.
Yeah, okay. So if you have any question, to drop it in the chat box and we will try our best to answer. So I will stop share now.